Yardi Matrix, National Multifamily Report, and there is a familiar market on the front cover page. It's a familiar skyline to us, Matt. Actually, kind of looking out the window, we can sort of see it. Yeah. I'll move this over. But Indianapolis, once again, top market for rent growth, and you don't have to go to the Sun Belt to experience some solid growth, Matt. I think that's the takeaway.
Yeah. A couple weeks ago, we got the monthly reports from Apartment List, and I'm also going to use this report in line with a Redfin report for monthly rent as well, to give us a little more context, maybe make these numbers a little more robust. But either way, starting with Yardi Matrix, they recorded 5.5% year-over-year rent growth and flat month-over-month rent growth in January, which is a slight improvement over the slight decline in December's rent numbers for month-over-month. Redfin actually put year-over-year rent growth at only 2%, and their monthly rent growth, which they don't list outright, and I had to do some math to calculate, their month-over-month rent growth is at a negative 1.9%. Actually, they may list it. I think I did needless math.
On the Redfin?
Yeah, they did list it. I just did math for no reason. But anyways, Redfin has big swings. Their peak year-over-year rent growth was 17.5% in early 2022, which compares to 15.3% for Yardi Matrix in February 2022. But back to Redfin, they do have some good market information. Their top markets are, and then I'm just going to buzz through these as quick as I can, Raleigh, North Carolina at 22.5%, Cleveland at 17.5%, Indy at 14.9%, Charlotte 14.2%, Nashville 9.8%, Kansas City 8.8%. Their worst performers were Phoenix at negative 6.7%, Oklahoma City negative 6.3%, New Orleans negative 5.2%, Minneapolis negative 5.1%, Houston negative 4.9%, Baltimore negative 4.6%. All of these negative numbers, they're and going back to Yardi Matrix, they don't have specific numbers for their markets, but none of them are negative. Again, big swings for Redfin, not as big of a swing for Yardi Matrix. Anyways, in terms of their list of the top markets, they have Indianapolis as the top at above 10%. Then there's a fall off really considerably until you get to San Jose, which is at 8% rent growth, followed by Miami at a little under 8%. And then the rest are kind of clustered around 7.5%, which these are markets like Kansas City, Raleigh, Charlotte, and Chicago. Really agreement in general with Redfin, just the swings are different.
Yeah. Yep.
Their worst performers on this list starts with Las Vegas, which may be like 0.5% rent growth, and then Phoenix, and then a big jump to around 2.5% rent growth for places like Baltimore, Sacramento, Atlanta, and the Twin Cities. Again, like decent agreement, but the amplitude is way stronger for the Redfin data. I'm not sure if amplitude's the right word, but definitely the waveform is a little bit more squiggly if you were to plot these out on a graph.
Yeah.
Bigger swings. But to kind of shift back to Yardi Matrix, their summary of relevant economic conditions really kind of jibes with what we were saying. If anything, is a little bit more positive. They reference the recent strong jobs report. They didn't factor CPI in because it wasn't written yet. That's fine.
Well, that's why you can't get a great report.
That's right. Even considering they reference the strong jobs report such that even considering the possibility of higher interest rates, they say, quote, early data indicates solid evidence for a multifamily soft landing in 2023. I mentioned before that, from April 2008 to August 2022, the federal funds rate was below 2.5%. Yeah. That's like a little over 14 years. That's a long time for people's memories to change and their expectations to change. I don't think that we've seen the full impact of higher interest rates on the mentality of buyers and sellers. But like you said, there are people around that have done deals in higher interest rates. So.
Yeah, but not necessarily with lower cap rates. And that's where the gap is, the chasm is because you still have some sellers who are like, it needs to be under 5. And then you've got buyers who are like, it needs to be closer to 6. I mean, the buyers are at 6 and the sellers are, 4.5 to 5. Yeah. And, it's so that kind of mid 5 range is who's on the seller side, who's willing to come down in price, up in cap rate, and on the buy side, who's willing to maybe come down a little bit in cap rate, up in price. Yeah. And there's still a wide gap. Again, it's a 100 basis point gap between buyers and sellers.
That's a good point.
At least on what they think it should be.
Maybe the people with the experience are the ones that are like, listen, you guys got to get comfortable with these changed numbers.
Yeah. It's a lot of lot of education, I think, on the broker side, and also a little bit of counseling, on the emotional.
Yeah. Oh, yeah, for sure.
Because I mean, these guys, especially if you had a good project, again, like maybe you just developed something and delivered it, and like you've got a loan coming due, you got a balloon payment, you got to do something, and even if you've got an assets in a good position and now you wanted to hold on to it, but now all of a sudden it's like, no, we may have to sell it now because we have to put a permanent loan on and at a rate that we would not crazy about and hold on to for a couple of years with the prepayment.
Yeah.
Matt, do you mind looking at the rent to income ratios?
Oh, totally. Yeah.
Again, I was like looking at this, and I'm really glad you already tracks it. And Matt, you actually pinpointed a couple of minor calculation errors, discrepancies in a previous report. Let you already know they have since fixed that. Yeah. They said, "Oh, yep, we missed it." So we're trying to keep them on their toes a little bit. But again, 30% is kind of your average for 30% of rent to income ratio is the typical national standard, and consider anything over that is considered rent burdened. And not surprisingly, some of the markets that are more rent burdened, over 30%, at the top, Orange County, California, San Francisco, Baltimore, Washington, D.C., Sacramento, Orlando, New York, Inland Empire, Los Angeles. So those are kind of the pricey metros, a lot of stuff in the middle right at 30, but then down here at the bottom. So this is, I think, one, just in general, more affordable metros. So lower rents, you're going to see probably some lower median incomes on average. And also a lot of these markets, this isn't necessarily to their advantage, but the housing markets in general are a little bit more affordable. You can actually buy a home, in Kansas City and Indianapolis and Cleveland, Ohio, and Columbus, Ohio. That gap between rents and mortgage payments isn't as drastic. So there's a little bit more competition still on the for sale market. But I mean, Kansas City, overall, 22.6%, I believe that's lifestyle. All units, they're at 24.6. Indianapolis is 25.8.
Those are the two lowest, right?
Those are the two lowest, yeah, 24.6 and then 25.8 for Kansas City and Indianapolis, respectively. And then San Jose, California, surprisingly. So, California City, other markets in California are pretty expensive, but San Jose is 25.9.
It didn't used to be like this specifically, but it is right now. Those are the leaders.
Those are the leaders.
The
affordability, flight to affordability.
Yeah, I think, and it also implies that there's even more room. It's not like things are getting less affordable in a relative way for these markets that are at the bottom. I would be expecting if Indianapolis got to be like in a bad situation, I would expect that number of rent to income to start creeping up in the list, but it's not.
I'll give the counter argument to the Midwest, and in a market like Indianapolis, we're usually promoting it because that's where we're from. That's where we do a lot of deals. But so here's the counter argument to a lot of that. I already mentioned that home prices are more affordable.
Yeah, that's a good point.
But you could look at it as Indy and Kansas City we're really outpacing a lot of these other markets. Another way to look at it is we're catching up. Is that we didn't see as much rent growth in the past, so we stayed affordable, and now we're just catching up a little bit. So it's all, I guess, your frame of reference and what period you're in. I think you could look at it as saying, that the Midwest is a lagging indicator, and that we can use other markets that are more leading indicators to give some insight. And it doesn't just have to be in real estate. It's a lot of trends in general. You could look at, again, this from someone that's from the Midwest, and I've lived in New York, in New York City, and I've lived in South Florida. You can see things that are happening like in New York. Restaurant ideas, concepts, and whatever it is, entertainment style of whatever the trend is, economic. Usually there's a delay until it gets to the Midwest. And so there's like an arbitrage of information or ideas. But there's some other areas where there's a little bit more of a leading indicator. You can see what is to come. So are we leading, or are we just catching up? I think that at the end of the day, it's, when you get in, how you get in, what's your basis, and what you do with it. But just I wanted to put that counterpoint, just because we're always talking about how great the Midwest is, and it's much less volatile. And when others go down, it stays stable. And when things go up, it goes up too, but maybe not as much. I think that there's more upside than people give it credit for. But there's some higher return markets out there, but it's, again, risk equals return.
Yeah.
Just coming back to that.
Yeah, I think that that was just my point. Is like, I think it just implies maybe that there is some room to grow.
Yeah, I agree. And again, just another counterpoint against the Midwest, Matt. Let's look at employment growth, job growth. Job growth is something you really want to keep track of, and completions as a percentage of total stock is also important. But let's look at San Jose at 5.1%, 6-month moving average of year-over-year job growth versus Indianapolis at 2.8. I mean, that 5.1 in San Jose, and the fact that it's affordable, that's attractive. They're also not building too many new apartments, 1.1% as a percent of total stock.
Yeah.
Indy's also very low, under percent, 0.9. But again, job growth is 2.8. So, I mean, San Jose, now you have to deal with some of the other issues of being in California, but maybe you don't have all the issues in San Jose as you do in a San Francisco or Bay Area. Now let's look at some other let's look at some of the big job growth markets. I mean, so we mentioned San Jose, Dallas 6.8, not too surprising. Chicago 4.1, Charlotte 5.4, Kansas City 1.6. Any other standouts here, Matt? Houston 6.2. I think, is Dallas topping the list at 6.8?
Yeah, looks like it.
I believe so. So not surprising. Dallas has been going gangbusters. Been doing really well. Now, another thing just to compare is that, again, the supply that's coming online, that's been highlighted as a major concern. I think most people who dig into it aren't overly concerned in the long term, more over the short term. Let's see what stands out. In Miami Metro, 3.5%. That's not too surprising. They've got great rent growth and pretty good job growth. Good job growth at 5.3%. Denver, 3.1%. 3.8% of new completions as a percent of total stock. So this isn't pipeline. This is just completion. What's actually been delivered, by the way. 4.8 in Austin. Not surprised there. Minnesota, Twin Cities, 4.6. It just, Minneapolis has had a rough time the past couple of years.
Yeah. So we have. That's a good like right down the line. Austin, you've got 5.5% job growth, and then 4.8% coming online, and then Twin Cities, you have about 2% less job growth, and then you have 0.2% less. You have virtually the same amount.
Yeah, and also less projected rent growth also. Or last year's rent growth and then forecasted as well. It's lower. So, Minneapolis. I mean,
Twin Cities was both Redfin and Yardi kind of agreed with that with those rent growth assessments.
We got to talk about occupancy, Matt.
Yeah,
occupancy's been coming down. You've had people are finally moving out. Some people are moving in with roommates, and we have seen some drops in occupancy for sure. I mean, we're looking at not a full 100 basis points. But we're approaching that pretty soon.
Yeah, I'd like to know what the long-term average is compared to kind of this current movement, because things really pinched.
94.5%.
Okay.
Or 95.
Yeah.
95 is what you shoot for. 95 is generally the average. It's probably a little bit below 95.
Okay, I wonder if
that's national average.
I wonder if we get there. I don't know. I think it seems to reason that we would still stay elevated.